Hello everyone, welcome to this third lecture of our last week for this course Metrics and Analytics of Marketing. In the last sessions, in the initial first two sessions of this week, we have been discussing about various metrics associated with return on investment, economic value added. In today's sessions, we will be specially looking into some metrics associated with the projects. So, most of the companies today, they are involved in various short term, medium term as well as long term projects. So, when we try to understand the cost and benefit associated with the project, then we have to take multiple aspects into consideration. It is not only about the financial cost and financial benefit that the organization is expected to get, but at the same time you need to understand when are you getting your investment back. If I take the example of a real estate company, it is a very capital intensive kind of industry. So, you cannot put or you cannot keep your money stuck in single project for a longer period of time, because you need to invest in another projects. So, that is why along with the financial cost and benefit, what becomes important for you is the when are you getting the money back. So, in today's sessions, we will be trying to look into these aspects, especially the time aspect of money, then time value of money, because let us say you invested 1 crore rupees today and you are getting something on installments. So, let us say 5 years down the line you get an amount of 10 lakhs rupees. So, in today's date, the value of the 10 lakhs rupees that you are getting 5 years down the line is not same, it is much lesser. I can give you this example. With 10 lakhs rupees in place, today I can purchase a, let us say, compact SUV. But 5 years down the line, if I get the 10 lakhs rupees 5 years down the line, then probably I will not get anything more than a hatchback. So, that is why the time value of money is important. Then we will also look into another concept called internal rate of return. So, basically it gives you a benchmark of what return you must get in order to continue with your project, right. So, it compares that where the net present value of the particular project is 0, the rate, the discount rate at which the net present value of a particular project is 0. This IRR or internal rate of return will be compared with something called the hurdle rates that I will explain in the subsequent slides. And then ultimately in today's session itself we will try to look into what is marketing return on investment or the incremental return on marketing initiatives. Okay, so let's start with our discussions for today. Let us set this context of today's discussion. Why the metrics that we have discussed in the previous sessions are not sufficient enough to explain the entire phenomenon of a business or entire phenomenon of a project. So, if we take the simple metrics such as return on investment or economic value added, they are nothing but some of the period snapshots. These metrics are important when you want to find out how the business is performing in a particular given period of time. But there can be a situation in the business where the project is involved during multiple periods. It takes 5 years, it takes 10 years. So, this metrics such as return on investment or economic value added, these are not sufficient or they are not suitable for the multi-period project evaluation. And that is why long-term initiatives need project evaluation tool, some of the other metrics which will take care of the time value, which will take care of the when are you going to get your investment back, which will take care of the how can you calculate the time value of the future cash flow, and what is the minimum rate that you want to decide whether you should continue with a project proposition or not, right. So, on this note, let us try to discuss some of the project related metrics. We will be confining our discussions with 3 project related metrics, and then we will take our discussion towards another kind of metric which is called marketing return on investment or marketing return on incremental investment. So, when we talk about this project related metrics, these metrics are payback metrics, net present value metrics and internal rate of return metrics. Let us look at each of this metric one by one, starting with this payback. Payback is nothing but a period, or in its simplest term, in its simplest form, let us say you have put some money on a business. So, you are expecting the return from the business. Whatever money you have put, at least that money you have to recover over a period of time. I am not talking about that money in absolute terms, but along with the adjusting for inflation or adjusting for expected or acceptable return. But another important aspect that remains significant for us, significant for a business decision is that are you getting the money immediately? Are you getting the money 3 years down the line? Are you getting the money back 5 years down the line? And this particular phenomenon, this particular question can be answered with this metric called payback. Basically, it is the time required to recover your initial investment. And once you recover, once you cross this payback limit, then whatever you are deriving from the business, it is your profit. So, risk part of your financial investment has got reduced after this period. This metric emphasizes on the speed of recovery. Am I getting my investment, initial investment in 3 years, in 5 years or in 10 years? Shorter it is, more risk free your investment is, because I mean we are living in a VUCA world, volatile, uncertain, ambiguous and complex world. So, it is relatively easier for me to predict tomorrow than predicting 5 years from now. That is why if your payback period is, let us say 1 year, it is always less riskier for you than if your payback period is 10 years. Uncertainty is more when the duration of the period is more. Now, let us look into this managerial use of payback. It is simple and it is intuitive, because it is just a period, the period within which you are getting your investment back, and it is intuitive in the sense that it answers a very significant and critical question of when are you getting the money back. Let us say if you are dependent on this particular set of money for running your day-to-day operations of the business, then you should look into this payback period before taking any financial decision or before taking any investment decisions. This metric is useful when liquidity or the risk containment matters. The example that I have cited is of real estate, right? So, if let us say you are a real estate builder, then you are into a very capital intensive business. It is always good for you if you can recover the money, if you can pay the, get the money back as early as possible, because your business is capital intensive and you need to run multiple projects at the same time. That is why transferring the money from one project to another project becomes a part of your business, and that is where the payback periods plays an important role. You can see that you can get a significant discount or significant lower rate at the under construction property as compared to a ready to move property. Why is it so? Because the real estate builder, they need immediate money. So, if you can pay them the money in advance, then they are in a way rewarding you by extending some discount, by lowering the price of the property. So, that is why payback period is extremely important. It needs to be reduced to a higher extent whenever you need a quick returns and your context of the business is valued upon the time period within which you are getting the money back. Then payback limitation. If I look into the limitation of this metric, it favors short term returns over the long term value because of the context of the business. It does not capture the full value of the future cash flows because it is more concerned about the short term period of value. So, it does not take into consideration the future value of the cash flows. That we will be discussing in the next concept, which is the NPV. NPV stands for net present value. NPV is the present value of the future cash flows after accounting for the time value of money. For example, let us say you are getting 100 rupees today versus you are promised to get 100 rupees 5 years down the line. In absolute terms, this is 100 rupees. Today you are getting 100 rupees and you have been promised to get 100 rupees 5 years down the line. But the value of these two instances are totally different. Let us say with this 100 rupees, just this hypothetical example, I can go to a nearby cafe and get a cup of coffee, right. 5 years down the line, with that 100 rupees, my utility is not that. I cannot go to that nearby cafe and have a cup of coffee. Probably if I have to get a cup of coffee, I have to end up paying 200 rupees. So, value of 100 rupees today is different from the value of 100 rupees 5 years down the line, and that is why it is important to account for that. It is important to understand this discount rate, understand the rate at which the money depreciates, or understand the inflation rate. So, if we understand these concepts, then in our accounting we will not definitely take the absolute value of the future cash flows. Rather, what we will take is the discounted value of the future cash flows, so that our project evaluation becomes correct. Basically, this matrix converts the multi-period cash flows into a single present value figures. In a way, we are standardizing everything and we are making the figures comparable, making today's figure versus future figure comparable. Why does NPV matters? Because of the fact that a rupee today is worth more than a rupee tomorrow. I mean, not today, tomorrow, but let us say 1 year down the line, depending on the rate of inflation. NPV accounts for timing and risk through the discount rate. Then it is one of the strongest tool for investment evaluation. Whenever we are investing something on a project, we will not get the return immediately. Rather, we can anticipate that we will keep getting the return over a period of time, that too in installments. So, that is why we need to capture what is the absolute value we are getting and at what point of time, and what is its equivalence value if we consider today's date, and then we can make our investment as well as our return comparable, and that is where the role of net present value comes into picture. We will look into the concept in details with numerical examples, so that we have a better understanding of this metric. So, before this numerical example, let us look into this formula. NPV is discounted value of the cash flows associated with the project. The present value of dollar received in given number of periods in the future is calculated by, that is cash flow in absolute terms in the future, divided by 1 plus discounted rate. Discounted rate can be your rate of inflation, discounted rate can be your how the value of money depreciates, right. So, it is cash flow divided by 1 plus discount rate to the power period. Remember that today's period is considered as 0th period. So, you can just put this value for this 0th period. Let us say it is $100, you are getting $100 today. The value of $100 today is, the today's value of $100 today is $100 only. So, now put at this one, let us say the discount rate is 10%, just for the sake of calculation. So, cash flow is $100 divided by 1 plus discount rate, that is 1.1, that is 1.1 to the power, what is the period today? It is 0. So, 1.1 to the power 0 is 1. So, that is why whatever cash flow is there, that cash flow is the value of that is the today's value, right. So, if it is next year and 10% discount, 1.1 to the power 1, that is 1.1. So, cash flow divided by 1.1, and similarly we will keep calculating the values of the future cash flows. Let us look at this simple example. Harry wants to know the dollar value of his business opportunity. Although he is confident about the success of the venture, all future cash flows have a level of uncertainty. This is the risk associated. After receiving a friend's advice, he decides a 10% discount rate on future cash flows is about right. Now, what he has to do? Let's say next year he is getting 15,000 cash, right? So, in this case, whatever I will be receiving in the next year, that needs to be discounted with the discount rate, and then I can establish, I can calculate a equivalent value of the money that I am going to get in the next year. If it is 10%, that is cash flow is 10% next year and divided by 1 plus 10% to the power 1, that is 15,000 divided by 1.1, which gives us a value of $13,636. So, I am getting in absolute terms, I am getting $15,000 in the next year, but today's value of this $15,000 that I am getting in the next year is 13,636. Now, this 13,636 becomes comparable with my today's investment. So, that is how we calculate the accumulated today's value of the future cash flows to compare whether the investment that we are planning to put is worth enough or not. Let us say this is the scenario, right. So, this year I have put $50,000 as an investment in the business, and for the sake of understanding that income or return that I am generating, this year I am not getting anything. In the next year I am generating a revenue of 15,000, profit of 15,000. In year 2 also I am getting a profit of 15,000, and year 3 also 15,000, 4th also 15,000, and 5th year also 15,000, right. So, this is just for the sake of simplicity, I have put the same value. Now, if I look at it in its surface level, it will look like that. For 5 years, I will keep getting $15,000. So, total $75,000, right, and my investment is $50,000. It will look like so lucrative, right, as long as I do not account for the time value for money. So, it looks like if I do not take the discount rate into consideration, the cost benefit would look like that return that I am getting is 75,000 and the investment I am putting is 50,000. So, it looks like I have a net profit of 25,000, right. But I need to understand the fact that the value, that money that I am getting in the future is not having the same value that the money I am getting today. It has to be discounted with respect to the calculated discount rate, and in this example let us take that the discount rate is 10%, right. So, discount rate of the money, value of money is 10%. So, I have to calculate this one. So, with this, if you can see on this first, second, third, fourth row, you can see I have put the formula. For year 0, the value will be the absolutely same. For year 1, the value will be multiplied by 1 divided by 1 plus discount rate to the power 1. For year 2, 1 divided by 1 plus discount rate to the power 2. For year 3, 1 plus discount rate to the power 3, and so on, right. So, if I go by this one, then in year 0 whatever I get, 100% value will be taken into consideration. In year 1, the value, the effective value of money is 90.9, that is 1 divided by 1.1. In the year 2, the effective value of money is 82.6, that is 1 divided by 1.1 to the square. In year 3, it is 75.1, that is 1 by 1.1 to the power 3, and so on. So, in the 4th year we have a value of 68.3, year 5 we have a value of 62.1, and as we keep on going with the year, the value of money, effective value of money percentage will get declined, okay. So, if it is in the first year I have a negative 50,000 because I have invested. In the second year I am getting an equivalent today's value 13,636. In year 2 I am getting 12,397, and so on. So, for all these years together, if I calculate the net value, it is 6,862. In absence of this discount value concept in place, then it will look like the overall net or gross value created for the organization will be $25,000, but in reality the effective value created from this business is 6,862. The NPV of Harris project is 6,862. NPV accounts for the fact that on a pre-dollar basis, cash flows received in the future are less valuable than the cash flows that is in hand, right. So, that is why as it is positive, we are safe to invest in this project. Let us look at the golden rule of the NPV decisions. You can accept this particular project if the NPV value is positive. The previous example, it is a positive value, that is why we can go with the project proposition. If it is negative, reject the proposition. Do not carry ahead with the project, because at the end of the day effectively you are incurring losses. Value is like higher NPV, more value created. Lower NPV, less value created. Negative NPV, value is destroyed. So, that is why these three golden rule needs to be kept in mind whenever you are taking a investment decisions based on your net present value calculation. Next concept comes into picture is internal rate of return, or in short IRR. So, this is similar to, or we can say that this is a special case of discount rate where the NPV value is 0. The discount rate at which the NPV value becomes 0 is called the IRR, right. So, at this particular discount rate, if you are going ahead with the project, neither you are creating any value in your investment, nor you are destroying any value out of your investment. Formally, IRR is the discount rate at which the NPV equals 0. It expresses the project attractiveness as a rate of return. When it comes to the decisions rule with this by using this matrix IRR, compare the IRR to the hurdle rate. What is hurdle rate? Hurdle rate is a particular rate that is given by the business analysis where we found that the investing the project is worth it. Basically, it is a function of weighted average cost of capital plus the risk premium that you expect in the business. As a golden rule, all of us understand that we will only intrude into a risky business, we will only invest in an uncertain business when the expected anticipated rate of return is higher. So, this particular risk return phenomenon is covered under a metric called the risk premium. Means I am putting the money in a risky business, I have to get certain risk premium. I will only put if it is worth taking the risk, because if I am getting it, I mean if risk is nullified at one point of time, or the uncertainty favors in my side, then in that case I am getting a lot of money. Okay. So, basically this hurdle rate is nothing but weighted average cost of capital plus the risk premium. What is weighted average cost of capital? If you are doing a business, then you have to get the capital from somebody, either from your business partners in the form of equity, or you have to take a loan from the bank. Now, if you are taking the money in form of, raising the money in the form of equity, you are expected, the business is expected to return some money on a periodic basis, let us say on a yearly basis, in the form of dividend. So, that dividend becomes your cost of equity. Similarly, if you have taken a loan, then in that case every year you have to return the interest to the bank, and that becomes your cost of debt, right. So, total cost of equity plus total cost of debt makes your overall cost of capital. Why it is called weighted average cost of capital? Because you might be taking 70% in the form of loan and 30% in the form of equity. As we know, the cost of equity is different from cost of loan. That is why it has to be, when we are calculating the cost of equity and cost of loan, it has to be distributed according to the proportion of capital, right. So, that is why we take the weighted average cost of capital. What is the cost of debt? What is the cost of equity? Fine. So, this weighted average cost of capital plus the risk premium means I will only invest the money in this risky business if I am expected to get, let us say, 5% premium over the cost of capital. okay, and that is called a hurdle rate. So, in case if your IRR, internal rate of return, that is the if your discount rate at which the NPV value becomes 0 is higher than this calculated hurdle rate, then it is wise for you to go with the project, otherwise do not go with the project. If the IRR is lower, then just pass, do not carry ahead with the project. Some cautions that you need to take into consideration where you are using IRR, this one metric for decision making. IRR does not show the scale. A small project and a very large project can have the same internal rate of return. Managers must not ignore the project size and the total value when using the IRR for decision making process, because it does not tell anything about the magnitude of the project. It only tells you the rate of return. Okay. So, that is why when taking a decisions regarding this business, then in that case IRR has to be looked in tandem with project size and the total value of the project. Because for example, if the project magnitude is so high, then even a small significant, I mean small percentage return also gives you a very big value. So, that has to be taken into consideration. Now, we will look into the last matrix for today's discussion, that is marketing return on investment. Sometimes it is also called the return on marketing investment. We will also look into the incremental return on marketing initiatives. So, why this marketing return on investment has emerged as a metric? Because the firms want to evaluate the marketing productivity, whether investing or taking a marketing initiative is worth it or not. How much additional value we are getting, how much additional profit we are getting because of this marketing initiative. Okay. Basically, whenever we are talking on marketing return on investment, we always look into the incremental value rather than the absolute value. Managers increasingly ask whether marketing spending pays back or not, and you have to answer these questions with numbers, and that is why an understanding of marketing return on investment as a metric is important. MROI or ROMI in short is an attempt to answer this question. So, concept wise it is the incremental financial impact attributable to the marketing initiatives, and if I as we are calculating it in terms of return on investment, means how much I am investing not in the entire business, rather how much I am investing in terms of the marketing initiatives and what is the gain I am getting. So, let us say that gain minus this investment divided by this marketing investment is called marketing return on investment or return on marketing investment. So, we will look into the formula subsequently. A necessary step in calculating the MROI is the estimation of the incremental financial value that is attributable to the marketing. This incremental value can be total attributable to marketing or the marginal value attributable to a new marketing initiative, right. So, while discussing about this incremental value, one thing we need to keep concentration on is that without that marketing initiative, how much value is anyway created. If we do not have an understanding of that, then there will be a spurious attribution of the value to the marketing initiatives. That is why it is first important to understand what value is created even in absence of the marketing initiative, and that is called the baseline financial value. Let us capture that value in terms of y naught variable or y0 variable. So, this is nothing but the value with $0 marketing expenditure. Then let us also calculate the level of total value, which is y1, financial value at marketing spending level x1, and another point that is y2, where the total value is y2, financial value at marketing spending level of x2. Now, if we take the difference between x1 and x2, that is the difference between these two levels of marketing expenditure, this represents the cost of an incremental marketing budget, right, the difference between x2 and x1. Okay. So, marketing budget item that is to be evaluated, such as an advertisement campaign or a trade show. So, we need to calculate this incremental expenditure along with the incremental value created. Normally what happens, we can capture this, you can simulate this phenomenon in the form of a graph. As you can see in this graph that y naught is the value that is created by your company with zero expenditure of money in marketing, right. So, there will be one point x naught on y naught, means x naught is 0. So, at 0 level of advertisement, you are anyway getting a value of y naught. At x1, you will get a value of y1, and at x2 marketing expenditure, you are getting a value of y2. Now, we will take up multiple situations. Financial value attributed to marketing at its highest level is y2 minus y naught. This is the incremental value because of this marketing expenditure. The increase in financial value attributable to the entire marketing budget, that is x2. Now, marketing return on investment, it is y2 minus y naught, right, because this particular value y2 minus y naught is the value that is happening because of the marketing. Up to y naught, the value is anyways happening, right. y2 minus y naught minus what is the cost of marketing, it is x2. So, y2 minus y naught, that is the incremental value, minus the cost of this marketing initiative minus x2 divided by total investment, which is again x2. This is the marketing return on investment. The financial value created by all the marketing activities divided by the cost of those activities, fine. Now, let us look into one more granular form of metric, that is return on incremental marketing investment or ROIMI. Okay. So, now how can we calculate this one? Difference in the value of the organization at different marketing expense level. At expense level x1 the value is y1, at expense level x2 the value is y2. So, that is why the incremental value at these two different level of marketing expenditure is y2 minus y1, and the incremental cost of this marketing initiative is x2 minus x1, right. That is why what is the incremental value, that is y2 minus y1, and what is the incremental cost, that is x2 minus x1. Okay. So, therefore, y2 minus y1 minus x2 minus x1 divided by x2 minus x1, this is the incremental financial value due to the incremental marketing spending divided by the amount of incremental spending, which is captured under this metric called ROIMI, return on incremental marketing investment. I think these three metrics phenomena are clear. So, one thing that I want to mention here is that as you can see in this graph, initially the value of marketing spending are high and gradually it diminishes over a period of time, right. Marketing expenditure diminishes over a period of time and it reaches stagnancy at one point of time. Therefore, how much spending has to be done in order to increase the market, value of the organization needs to be optimized with numbers. Now, let us quickly look at the core challenges in marketing return on investment. First thing first critical thing that comes to mind, that comes into the picture is that the baseline must be estimated correctly. In absence of that, every calculation, every attribution goes wrong. Managers must separate normal sales from the marketing driven incremental impact. What sales you will achieve even without any marketing initiative. Without a valid baseline, the MROI becomes misleading. Then let us look into the good use of MROI. Compare the campaigns of different sizes, evaluate the relative marketing productivity and combine with judgment, not in isolation. So, it is a comparative analysis. It can compare the performance or productivity of campaigns which are of various magnitude, fine. So, I will conclude today's class with this statement that project metrics help evaluate long term investment, while marketing return on investment helps assess the marketing productivity, but only when the incremental impact is measured carefully and correctly. Thank you. I will see you in the next class.